Welcome to the deep dive. We know why you're here. You, well, every ambitious investor, are probably searching for that definitive blueprint, right? That list. What are the top real estate markets in the country right now?
Yeah, everyone wants that shortcut. The insider info on where the smart money is really flowing today.
And look, while the stack of sources you provided us, which, believe me, we've spent the last week really digging into, well, they didn't just hand us a literal top 10 hottest markets list.
No, they didn't. But maybe they gave us something more powerful, actually. This collection, it covers everything. Investor psychology, the hard math of financing, deep dives into urban policy, financing structures, even the systemic history of the 2008 crash. It's really the essential roadmap.
That's exactly it. That's the real mission for us today. We're kind of skipping the symptom, the hot market list, and going straight to the cause. We're extracting that foundational intelligence, the toolkit, the operational checklist you actually need to find the next enduring market, wherever it pops up, and then build a portfolio that can actually withstand the inevitable economic shocks once you're in there.
Right. We're moving from, the microscopic math of valuing just one property all the way up to the macroscopic forces, the things that shape entire cities and define massive financial risk.
And the core lesson, I think, running through all this material, it's maybe sobering, but it's also empowering. Real estate investing, it isn't really about luck or guessing where the next boomtown might be.
Not at all. It is fundamentally about systems. It's about mastering the math and, maybe most importantly, understanding and, crucially, mitigating risk.
Okay, so let's unpack this. Let's start with the investor themselves, that psychological shift required to even begin succeeding.
That really is the only place to begin, isn't it?
Okay, let's jump right into Section 1, the investor's blueprint. Before we even think about spreadsheets and, debt instruments, we have to recognize this foundational shift in financial thinking that the sources really demand. This is often the biggest hurdle for new investors, wouldn't you say?
Oh, it truly is. Most people are just focused on trading their time for money. What accounting calls ordinary earned income.
The paycheck.
The paycheck, exactly. The goal, as it's laid out in this material, is to shift your entire way of thinking, your paradigm, towards generating passive income primarily from real estate in this context, and also portfolio income, which you get from paper assets, stocks, bonds, that sort of thing.
And the crucial distinction there is that ordinary earned income is, it's limited. There are only so many hours in a day you can work.
Exactly. But passive income, that scales with your asset base.
Right.
So if you want to build real, generational wealth, you absolutely must commit to constantly increasing your assets. These are the dynamic income generators that literally get your money working for you, the investor, not the other way around. And this isn't necessarily about, quitting your day job tomorrow.
Yeah.
It's about making sure every dollar you earn from here on out gets funneled toward building those passive or portfolio income streams.
And when you look at real estate specifically, the sources give this kind of staggering detail that really illustrates the power of this asset-based approach. Even in a scenario where the market is completely flat, no appreciation at all.
Yeah, this is the hidden math that kind of blows people's minds. Let's just isolate one factor, amortization. Say you buy a property. Okay, $100,000 purchase price, you put down $10,000.
Okay.
Now imagine the property value never goes up. Not $1. And let's ignore cash flow for a second, too. You still succeed in the long run. Well, over 30 years, as your tenants make their monthly rent payments, part of that goes to paying down the principal balance of your mortgage, slowly but surely.
So the debt shrinks.
The debt shrinks, meaning at the end of the 30 years, you end up owning a $100,000 asset free and clear. And you only put in $10,000 initially. That $90,000 gain just from the debt paydown from amortization, that alone represents an 8% annual return on your original $10,000.
Wow.
And that's without factoring in a single dollar of cash flow or appreciation. You've multiplied your net worth tenfold just by having a decent loan structure in place. Now imagine doing that several times over.
Right.
That compounding power of making several leveraged investments like that over time is how you see both net worth and passive income just multiply exponentially.
Okay, that definitely demonstrates the potential, but it also screams, you absolutely cannot manage 10 of those properties by yourself.
Exactly.
Which leads us right into the next big idea. The system's advantage.
Absolutely. This is the fatal trap for so many new investors. They get stuck in the role of the technician, doing all the work themselves, fixing the plumbing, leasing the units, taking those midnight calls.
In there.
Right. So to scale up, to actually use that compounding power we just talked about, you must transition. You have to become the entrepreneur or the manager, someone who designs and orchestrates a system that can scale.
I found the psychological hurdle described in the sources here just so relatable. Outsourcing, delegation,
Mm-hmm.
these are learned skills, aren't they? Because we have this ingrained belief that, well, nobody can do it quite as well as we can.
Oh, yeah, that's the classic "they're all idiots" phenomenon. When you first delegate something, the quality of the work often does drop a bit, temporarily.
Right, and then you want to snatch it back.
Exactly. The impulse is to take it back and just do it yourself. But a successful manager, they learn to trust the system more than any single individual. They recognize their time is the most valuable resource they have, and it has to be spent on that 20% of tasks that drive 80% of the financial growth. You leave the rest to the delegated team. You have to accept the trade-off. Maybe the team does it 80% as well as you could have.
Okay.
But the extra time you gain back is worth like 200% of that difference. That's the leverage.
So that system relies heavily on building a reliable infrastructure. The sources boil this down to finding your core four.
That's the non-negotiable team, right?
Yeah.
Your lender, crucial.
Yeah.
Your real estate agent,
Yeah.
your contractor, and your property manager. You absolutely have to find these people, vet them really rigorously, and build solid working relationships. Even, and this is key, even if you're investing in a market hundreds or thousands of miles away.
And the sources are pretty blunt about the property manager role, noting that finding a truly good one is, well, notoriously difficult. Why is that so hard?
Because the job is awful. Let's be honest. It requires this really rare combination of legal know-how, emotional distance, you can't get sucked into tenant drama, and just constant availability.
Yeah, the late night calls.
Late night calls, mediating disputes between tenants, and as the material points out quite vividly, dealing with a huge array of lies and excuses tenants will have for not paying rent on time.
Oh.
Plus, the profit margins for property management companies are often pretty thin, which leads to high turnover in the industry. So an investor who finds an excellent property manager, you treat them like gold. Seriously, they are the shield protecting your time and, frankly, your sanity.
Okay, so you have the asset, you have the team running the system. The final piece of this investor blueprint seems to be about communication. How you talk about what you do. This seems critical, whether you're selling a property, pitching a potential partner, or even just marketing a rental unit. We saw the story brand framework mentioned, and ninja selling techniques too.
Yeah, the overarching theme there is just absolute clarity. If you confuse people, you lose them. Simple as that.
Right.
People are just bombarded with information constantly. You need a really succinct message that immediately tells the prospective buyer or seller or tenant how you are going to solve their problem.
And the sources point out a key mistake that realtors, investors often make here.
Yeah.
They center the presentation on themselves, their company, their history.
Oh, it's the ultimate self-sabotage. Think about it. When you sit down with a seller, what do they care about first and foremost?
A price, what they walk away with.
Exactly, the bottom line. So, if a realtor spends the first 20 minutes talking about their company's history or explaining all their credentials, showing off awards, the seller just mentally checks out. All they hear is blah, 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 me, me, me.
Right.
You need to get straight to the value proposition. And if you're a realtor, often that means getting to the estimated price or the range pretty quickly.
So if the message shouldn't be about the character, meaning the investor or the realtor, it needs to focus on the customer.
Right.
Aligning with their sort of primal needs.
Yes, exactly. Every effective narrative, whether it's in real estate sales or Hollywood blockbusters, it's ultimately about survival.
Survival. How so?
Well, survival in a broad sense.
Yeah.
Physical security, financial security, emotional stability, social acceptance, your product, your service. It needs to be positioned as something that helps the customer survive and thrive in one of those areas. A house isn't just wood and drywall, right?
Yeah.
It's shelter, that's physical survival. It's a means of building equity, that's financial survival. It's a place to raise a family, that's social and emotional well-being.
Okay, that makes sense. And to structure that message effectively, the sources recommend this concise one-liner using 4 components: character, problem, plan, and success. Can you walk us through how an investor might actually use that, like in a real situation?
Sure, let's take pitching a joint venture partner. Your character isn't you, it's the potential partner.
Ah, okay.
Their problem might be that they have stagnant cash just sitting in a savings account losing value to inflation. Your plan is the specific joint venture strategy you're proposing, maybe buying undervalued duplexes in a specific high-growth tertiary market using the BRRR method we'll talk about later.
Yeah.
And the success is the outcome you project for them maybe doubling their passive income in 5 years, stabilizing their financial future. See how that one-liner immediately connects your operation to their survival goal? It's about them, not you.
That's powerful. And once you have that clarity, you need action. The material really emphasizes clear calls to action.
Absolutely. You have to tell the customer exactly what to do next. Don't leave them guessing. There are basically two main types. First, the direct call to action. This demands immediate commitment. Things like sign here, schedule the showing now, buy now.
Pretty straightforward.
Right. But sometimes they aren't ready for that level of commitment yet, so then you need the transitional call to action. This is designed to deepen the relationship without applying too much pressure.
Like what?
Offering a free market report, maybe a checklist for first-time home buyers, or getting them to sign up for an automated email drip campaign. That drip campaign works for you 24/7, providing value, building trust. That consistency is what turns prospects into actual clients over time. It keeps the whole system running smoothly.
Okay, that takes us really smoothly into Section 2, the practical mechanics. Once the team and the systems are starting to take shape, the investor has to get granular, right, down to the numbers. So how do we quickly use the math to vet if a property that seems to fit our system is actually a worthwhile financial move?
Yeah, let's get into the numbers. We start with the quickest, maybe the most common metric, return on investment, or ROI. The formula is beautifully simple, really. You take the monthly cash flow, multiply it by 12 to get the annual cash flow.
Okay.
And then you divide that by your initial investment, the actual cash you put into the deal, your down payment, closing costs, immediate repairs.
So an example.
Sure. Let's say you put $50,000 cash into a deal, all in, and it nets you $500 a month after all expenses. That's $6,000 per year, 500 by 12. So $6,000 divided by your $50,000 investment gives you 0.12, or a 12% ROI.
Okay. Seems easy enough, gives you an instant snapshot.
Yeah. It does, but this is a big but the sources caution us about. ROI has a pretty significant limitation, especially when you're trying to compare different types of deals, like, say, a quick flip versus a long-term rental hold.
What's the limitation?
It completely ignores the time factor. Time is money, right? Imagine two identical properties, okay? Both end up yielding a 12% ROI on the cash invested. Property A was a turnkey rental, already fixed up, tenant in place, took you 30 days to close. Boom, cash flow starts.
Nice.
Property B, however, was a total gut rehab. It took 18 months of construction, dealing with permits, regulatory delays, paying holding costs, before it finally started producing that same $500 a month cash flow. When you just look at the final ROI number, 12%, they look equal. But Property A was way, way more efficient with your capital and your time.
So simple ROI isn't enough for comparing different strategies, which brings us to average annual return, or AAR, as a potentially more robust metric.
Yeah, AR is better for that kind of comparative analysis precisely because it does incorporate the lifespan of the project and the timing of when cash goes out and when it comes back in. A sophisticated investor really needs to move past just simple ROI calculations when they're comparing diverse portfolio decisions. You use AAR to help decide if, say, a 6-month flip justifies tying up that capital compared to maybe a 10-year rental hold strategy.
Okay, got it. Moving beyond just measuring the return, we have to talk about valuing the property itself, especially when you get into larger income properties, multifamilies, commercial buildings. This is where net operating income, or NOI, really takes center stage.
Right. The absolute core concept for valuing these bigger income properties is that their value is fundamentally defined by the cash flow they generate. Simple as that.
Yeah.
The NOI is the property's total income after you deduct all the operating expenses.
Like what?
Things like property taxes, insurance, property management fees, repairs, maintenance, utilities if the owner pays them. Basically everything it costs to run the property day to day. But crucially, this is before you account for debt service.
Before the mortgage payment.
Exactly. Before the loan payment. That's key.
And that NOI number is the essential ingredient for calculating the cap rate, which everyone seems to talk about.
Correct. The capitalization rate, or cap rate, is simply the NOI divided by the property value, or the asking price if you're evaluating a purchase. This number, expressed as a percentage, represents the theoretical rate of return an investor would get if they bought the property entirely with cash, no loan involved.
So it lets you compare apples to apples.
Precisely. It's the metric that allows you to instantly compare the market pricing of one apartment building against another similar one in the same city or submarket. If similar properties are consistently trading at, say, a 5% cap rate in that area, and an investor finds a property that's generating $50,000 a year in NOI, they can quickly estimate that its market value should be around $1 million. $50,000 divided by 0.05.
Now, here comes the critical caution that the sources really flag. What should an investor immediately think or assume if they see a property advertised with a cap rate that's significantly higher than the local average? Like if the average is 5% and this one is listed at 8%, looks like a bargain, right?
Wrong. Alarm bells should be going off. You must immediately assume something is wrong with the property or the numbers, not that you've stumbled upon some secret amazing deal.
Why?
Because if the average cap rate in that area for that property type is 5% and this one is listed at an 8% cap rate, there's almost certainly an underlying risk baked into that higher return. That high cap rate usually indicates one of a few things. Maybe inflated income projections that aren't realistic, maybe massive deferred maintenance hiding just below the surface.
Like a roof needing replacement soon?
Exactly. Imminent major capital expenditures like a new roof, HVAC system failures, foundation issues. Or maybe the current rents are unsustainably high because they're based on short-term leases that won't renew at those rates. A high cap rate signals a high-risk premium. The market isn't stupid. It's telling you something's off. You need to figure out what.
Okay, that's a crucial warning. Speaking of deferred maintenance and things being off, let's look at the financial dangers lurking in renovations. When investors estimate rehab costs, the material stresses this direct correlation. The simpler your estimation method, the more accurate it tends to be. Explain that.
Yeah, it sounds counterintuitive, but the goal of a rehab, remember, is not aesthetic perfection. It's not even maximizing the amount of work you accomplish.
Right, it's maximizing profit.
It's maximizing profit, which means the investor needs granular, realistic numbers from the start. When budgeting for even what seems like a simple cosmetic fix, people constantly underestimate the hidden or secondary costs. Take painting, for example. For a decent mid-grade paint, you might budget, $20 to $40 per gallon? Seems manageable, right?
Yeah, seems okay.
But the real cost isn't the paint itself.
It's the prep work.
It's the prep work, which novices almost never factor in correctly. All the scraping, the patching of sheetrock, taping off fixtures and trim, protecting floors, cleaning everything up afterwards, material disposal. Depending on the current state of the property, that prep work can easily add anywhere from 50% to maybe even 150% more to the project cost than just the materials alone.
Wow.
And the sources emphasize that seemingly simple construction sequencing details can massively impact profitability. For example, rewiring an old house when the sheetrock is already off the walls costs way, way less than having to cut open existing walls, run new wires, then patch everything, retexture, and repaint. Efficient rehab planning is really about minimizing the total amount of work and disruption required, not just maximizing the visible aesthetic change.
That makes perfect sense. So once the math looks solid, the valuation checks out, the renovation plan is realistic, we still have to address the common challenge: funding the deal. Especially for investors who are maybe starting out with less cash, or maybe they're self-employed and can't easily get through conventional bank underwriting. This brings us to the famous BRRR method.
Yes. BRRRR. Buy, rehab, rent, refinance, repeat. It's really the quintessential strategy for trying to scale relatively quickly in real estate. You're essentially treating the property like a flip first,
Okay.
but with the long-term goal of holding it as a rental. So you typically use quick, often expensive, short-term financing, maybe cash if you have it, hard money loans, or a home equity line of credit, HELOC, on another property to acquire the distressed asset and fund the renovation quickly.
And the success, the entire BRRR strategy really hinges on one critical step: the refinance hurdle.
It is absolutely the make or break step. The property must appraise for significantly more than your total cost basis. That's your purchase price, plus all your rehab costs and holding costs.
Why is that so critical?
Because when you go to a conventional bank for the final long-term mortgage, the refinance part, they will typically only lend you up to maybe 70% or 75% of the new appraised value. Not what you paid, but what it's worth after the rehab.
Ah, okay.
So if that new loan amount isn't enough to completely pay off the expensive short-term financing you used, and ideally pull most or all of your original cash investment back out, the strategy fails. Your capital gets stuck in the deal and you can't repeat. You absolutely need to identify that potential for forced appreciation value created directly by your planned rehab before you even buy the property.
Okay. But what if conventional financing for that refinance step is just impossible? Maybe credit issues or being self-employed.
Yeah.
That's when investors often turn to more creative solutions.
Yeah.
You mentioned hard money earlier. The trade-off seems to be speed versus very high costs.
Yeah, hard money is financially brutal. No way around it. You're looking at interest rates that can be double, triple, or even quadruple what conventional loans charge. Plus, you usually pay significant points up front. Those are fees calculated as a percentage of the loan amount.
Sounds painful. Why use it then?
Speed and simplicity. Hard money lenders can often close incredibly fast, sometimes in days, which can be essential to snagging a competitive deal. And they often waive the intense scrutiny of your personal income, tax returns, and credit history that banks demand. They care more about the asset itself. So it can work if the project timeline is very short, the potential profit margin is really high, and that speed is absolutely critical to securing the deal in the first place.
Makes sense in specific situations. And the other main creative tool often discussed is seller financing, which bypasses banks entirely.
Yeah, seller financing can be a really powerful negotiation tool, especially when conventional loans are off the table. It allows the investor and the seller to negotiate the down payment amount and the loan terms directly between themselves.
So potentially lower down payment, more flexible terms.
Exactly. You can potentially negotiate a much lower down payment than the 20–30% banks often require. It's flexible, usually much quicker to close than a bank loan, and it can open doors for investors who might have weaker credit but can build rapport and trust with the seller.
But that flexibility, as the sources point out, carries a hidden, potentially massive risk if the seller still has an existing mortgage on the property they're selling you. We're talking about the due on sale clause.
Uh-huh. The dreaded due on sale clause. It's found in nearly all standard conventional mortgage agreements. And it basically states that if the title of the property is transferred to someone else, or if the property is used as security for a new loan without the original lender's permission, which is exactly what happens in most seller financing deals where the underlying mortgage stays in place, then the original lender has the right to demand that the entire remaining loan balance be paid back immediately, in full.
Wow. So if the bank calls the loan due, and the new buyer, using seller financing, can't suddenly come up with, say, $200,000 to pay off that underlying mortgage.
The property faces foreclosure. The original lender can take it back, wiping out both the seller's position and the buyer's investment. It's a huge risk.
So why on earth do investors take that risk? Do banks actually enforce this clause often?
Well, that's the tricky part. In theory, yes, it's a devastating risk hanging over your head. In practice, banks often choose not to enforce it, as long as the original loan payments keep being made on time.
Why not?
Primarily because enforcing it requires legal action, which costs them time and money. And usually, if the loan is performing, they're happy to keep collecting the interest. But the key word is choose. The right to enforce it remains in the contract. So every investor using seller financing on a property that still has an underlying mortgage needs to be acutely aware of that potential legal time bomb.
Okay, a lot of risks to manage there. But despite all these hurdles and risks, the ultimate power of real estate, according to the sources, lies in its unique leverage advantage. Specifically, the ability to access the equity you build up without having to sell the property and trigger a taxable event.
This really is the genius of this asset class, isn't it? Unlike selling stocks, where you realize a gain and typically owe capital gains tax right away,
Right.
real estate allows you to buy potentially undervalued assets, maybe force appreciation through rehab, let the market lift it, let tenants pay down the debt, and then you can convert those equity gains into liquid cash. You do this via a cash-out refinance or by opening a home equity line of credit, HELOC, against the property.
So you pull cash out, but you still own the asset.
Exactly. You effectively get access to the wealth created by the asset's appreciation without selling it, and often without paying immediate taxes on that cash received. That is the engine of long-term wealth building that the sources keep coming back to, using leverage safely and accessing equity tax efficiently.
Okay, that really completes our deep dive into the micro-strategies, the nuts and bolts of individual deals. Now we need to shift our focus completely, zoom way out to Section 3, the macro environment. Because, as the sources strongly argue, the greatest individual property deal in the world can't save you if the entire system around it, the city, the policies, the broader economy, is structurally unsound or heading for trouble. This is where we really have to analyze macro risk.
Yeah, you absolutely have to understand the larger forces shaping modern American cities. And a key concept the sources introduce here is something called the Great Inversion. This is a fundamental reversal of the dominant trend we saw throughout most of the 20th century.
Which was?
That was the era of white flight, where affluent, predominantly white families fled deteriorating inner cities for newer, more homogeneous suburbs, leaving the urban core increasingly impoverished.
Okay, so what does the Great Inversion look like today? How is that flipped?
Yeah. Today, we're seeing the opposite in many places. Highly educated, often affluent individuals and childless couples are returning to inner city neighborhoods. They're drawn by, shorter commutes, professional opportunities clustered downtown, and certain lifestyle amenities.
Okay.
Meanwhile, immigrants and many lower-income families are increasingly finding themselves pushed out toward the older inner-ring suburbs or even further out into surrounding towns, primarily because they're chasing affordability that no longer exists closer in. This shift, which is dramatically magnified in what they call superstar cities and major tech hubs.
Right, like San Francisco, New York, Seattle.
Exactly. It's creating what some analysts are calling a new urban crisis.
And one of the most visible symptoms of that crisis is this alarming rise in rent burden across the board.
Yeah, it's stark. When you have this influx of high-earning residents competing for limited housing stock, often constrained by zoning, which we'll get to, prices just skyrocket, and the effects ripple outward, hitting everyone. Look at the data for New York City cited in the sources. Between the year 2000 and 2014, the share of households spending 30% or more of their income on rent, that's the standard definition of being rent burdened,
Right.
it jumped from 41% to 52%, over half the city. And what's really telling is that this increase wasn't just happening in the rapidly gentrifying hip neighborhoods, it was also severe in the already distressed non-gentrifying neighborhoods too. It just shows this pervasive lack of affordable housing options across the entire urban region.
And the human cost of this housing crisis is immediate and devastating.
Yeah.
The sources highlight the shocking severity of the eviction crisis, using places like Cleveland, Ohio as a really stark example.
The statistics are just devastating, yeah. Based on data from 2012-2013, nearly 12%, think about that, 12% of all renter households in the entire city of Cleveland were summoned to eviction court annually.
Wow, 1 in 8 renter households.
Every
Every year.
That level of churn, of instability, it demonstrates a profound social and economic failure. Now, for an investor looking at a market like that, what do those statistics signal? They highlight the operating environment you're entering. Potentially high-risk tenants, probably high property management turnover and costs, and the constant underlying reality that many low-income tenants are just one unexpected expense. A car repair, a medical bill away from financial collapse and eviction. Understanding that dynamic is absolutely crucial for setting sustainable rent levels and managing your expectations realistically.
It seems impossible to really understand today's housing market, especially the affordability and segregation issues, without recognizing the incredibly long shadow cast by past government policies. Policies that didn't just allow, but actively created segregation and structural scarcity. This goes back nearly a century, doesn't it?
Oh, absolutely. And the primary culprit identified in the source material is the Federal Housing Administration, the FHA, which was created back in 1934 during the New Deal.
What was its purpose?
Officially, the FHA was established to ensure bank mortgages on homes, making them less risky for lenders, which was meant to stabilize the housing market after the Depression. But, and this is critical, to minimize its own risk of having to pay out insurance claims on defaulted loans. The FHA mandated incredibly strict appraisal standards. And these standards were inherently and explicitly racist from day one.
Explicitly. So they actually included an official requirement for racial segregation.
Precisely. It wasn't subtle. The FHA created these infamous maps, often called residential security maps, that graded neighborhoods across the country on a scale from A, green, considered the safest for lending, down to D, red, considered the riskiest.
This is where redlining comes from.
This is exactly where the term redlining originates. To receive an A or even a B rating, and thus get access to FHA insurance, which quickly became essential for banks to issue affordable long-term mortgages, a neighborhood had to meet a strict whites-only standard in practice. If a neighborhood was racially mixed, or even if it was an all-white neighborhood but located adjacent to a black neighborhood that the appraisers thought might integrate in the future, it was automatically graded D, outlined in red.
Red line.
So the federal government itself essentially made racial segregation an official requirement for accessing the primary tool for building middle-class wealth in post-war America.
That's exactly what happened. It officially institutionalized racial segregation in housing finance and deliberately restricted access to homeownership and the intergenerational wealth that comes with it for Black families and other minorities for decades. The effects are still profoundly felt today.
And this intentional federal policy was then compounded, or maybe cemented, by the rise of local zoning ordinances across the country. The sources make an interesting point here. Zoning didn't become culturally acceptable in the U.S. because people suddenly loved government control over land. It was actually justified as a way to defend private property values and uphold this ideal of economic individualism.
That's the core paradox, isn't it? Zoning became the primary legal tool used at the local level to protect the homogeneity and exclusivity that the FHA's lending policies had already established financially. This led directly to the invention and widespread adoption of the exclusive single-family zoning district, a type of land use separation that is actually among the strictest in the entire industrialized world.
Really? Stricter than Europe?
In many ways, yes, especially regarding the prohibition of mixing even slightly denser housing types like duplexes or small apartment buildings within single-family areas. This, the sources argue, reflected a deep-seated American anti-urban individualism, this historical idea that the dense city was somehow morally corrupt, and the ideal citizen was the self-sufficient Roman farmer living on his own exclusive plot of land separate from others.
So restrictive zoning, making it literally illegal to build anything other than a detached single-family home on vast swaths of land in most American cities and suburbs, isn't just about neighborhood character or aesthetics. It's a direct legacy of policies originally designed to maintain racial and economic separation, and it creates artificial scarcity.
And that scarcity is arguably the single biggest driver of the housing affordability crisis we face today. By severely limiting the supply of different housing types, especially missing middle density like duplexes, townhomes, quadplexes, small apartment buildings, these zones artificially inflate the price of both land and housing, reinforcing the economic and often racial divides that the FHA helped create generations ago.
Okay, let's pivot now from urban policy history to the more recent history of systemic financial risk, drawing lessons specifically from the 2008 subprime mortgage crisis. For our listener trying to navigate today's market, understanding the mechanism of that collapse seems crucial for spotting potential bubbles or hidden risks now.
Absolutely. The source material focuses quite heavily on the small group of contrarian analysts, people like Michael Burry, who saw the calamity coming when almost no one else did. Burry's thesis, interestingly, was rooted in a fairly simple observation about the structure of subprime mortgages themselves.
Nice choice.
They were almost all structured with teaser rates, these artificially low introductory interest rates and payments that lasted for maybe 2 years. After that, the rates would reset, often causing the monthly payments to skyrocket by 30%, 50%, sometimes even more overnight. Burry correctly anticipated that millions of borrowers wouldn't be able to handle that payment shock, especially if home prices stopped rising and they couldn't refinance. He predicted this reset would trigger a fundamental deterioration in the underlying mortgage pools. He saw the cliff coming.
Yet Wall Street kept packaging these increasingly toxic loans into ever more complex securities. This brings us to the infamous product that really poisoned the entire financial system: the collateralized debt obligation, or CDO.
Right. This is where the failure in risk calculation became truly catastrophic. Big Wall Street investment banks, like Morgan Stanley mentioned in the sources, were creating these CDOs. They'd take thousands of individual subprime mortgages, pool the expected payments together, and then slice that pool of payments into different layers or tranches based on risk.
Like slicing a cake.
Sort of, yeah. The highest tranche, the top layer, was supposed to be the safest, typically rated AAA by the rating agencies, like Moody's and Standard & Poor's. These were supposed to be virtually risk-free investments. But here's the problem. Traders, like Morgan Stanley's Howie Hubler, who the sources profile, were buying absolutely enormous amounts, $16 billion in his specific case, of these supposedly super safe AAA-rated CDOs that were, in reality, constructed almost entirely out of the riskiest layer, the BBB-rated tranches of underlying subprime mortgage bonds.
Hey, how could a bond made entirely of the highest risk junk mortgages possibly be rated AAA, the safest rating available? That doesn't make any sense.
It doesn't. And that was the core delusion. The rating agencies, Moody's, they were the essential linchpin holding the whole fragile structure together. And according to the sources, they were basically maximizing their own fee income by rubber stamping these increasingly complex structured finance products created by Wall Street.
Why would they do that?
They operated, along with the entire industry, on a fatally flawed core assumption that U.S. home prices, nationally, would essentially always continue to rise, or at least never fall significantly all at once. Based on that assumption, their models predicted that even if some homeowners defaulted, overall loan losses in these diversified pools would be capped at maybe 5% or so, even in a downturn.
Okay.
And under that 5% loss assumption, the models showed that even the CDO tranches built from the risky BBB subprime bonds would still be safe enough to warrant a AAA rating.
But what happened when actual losses started exceeding that magical 5% threshold?
The whole house of cards collapsed. When the actual default rate on the underlying subprime mortgages hit just 8%, not some crazy high number, just 8%, those supposedly risk-free AAA-rated CDOs, like the $16 billion Hubler bought, became practically worthless almost overnight because they were built entirely on the riskiest underlying pieces, which were the first to get wiped out. The analysts who questioned the structure beforehand, like Mike Eisman, who was also featured, they realized the rating agencies weren't really doing objective risk analysis anymore. They were just focused on generating transaction fees and maintaining market share by giving Wall Street the ratings it wanted. The entire system was incentivized towards maximizing short-term profits based on mathematical models that, as the sources bluntly state, simply never made sense given the deteriorating quality of the underlying loans.
It was a complete systemic failure, wasn't it? Where profit maximization, completely decoupled from any realistic assessment of risk, almost cratered the entire global economy. So the huge macro lesson for today's investor seems clear.
Yeah.
You simply cannot trust market momentum blindly. You can't just rely on the projections of those who stand to profit most from transaction volume, whether it's brokers, lenders, or even rating agencies sometimes.
Absolutely. The savvy investor today has to critically analyze the inputs behind the numbers. What are the assumptions behind that cap rate? What's the real condition of the property? What are the local economic trends? You have to remember that even supposedly safe investments, especially complex structured debt, can be based on deeply flawed assumptions about the future, like the perpetual rise of home prices, the very same assumption that led directly to the 2008 collapse. History doesn't repeat exactly, but it sure does rhyme.
We have covered a tremendous amount of ground today.
Yep.
Wow. We went all the way from the sort of psychological blueprint required to even start investing successfully.
Right, that mindset shift.
Through the necessary nuts and bolts math of things like ROI and cap rate, and then finally all the way up to these colossal systemic risks embedded in our financial history and urban policy.
Yeah, and for you, the learner, the real key takeaway from all this, the way to build a truly resilient real estate portfolio, is finding that balance between these two scales, right? You absolutely must master the micromath. You need to understand ROI and its limitations. You need to be able to accurately calculate and interpret a cap rate, know how to execute strategies like BRRR effectively, and critically build your operational systems, finding that core 4 team, learning how to delegate.
But as we saw, that brilliant microstrategy is only ever as strong as the macro environment it exists within. You have to be able to critically assess those larger macro forces too. Understand the historical constraints imposed by things like exclusionary zoning, recognize the persistent and often worsening crisis of rent burden in many American cities, and internalize the hard-won lessons from past financial collapses about systemic risk and fundamentally flawed valuation models.
Exactly. Understanding those macro forces is what prevents you from making what looks like a perfectly executed, profitable micro investment. But in a location or a sector that underlying policy changes or brewing systemic risks are about to completely dismantle or severely devalue, you need both lenses.
So to bring us back to financial history for our final provocative thought today, the sources offer a really interesting parallel when thinking about market cycles and valuation. It reminds us that valuation relationships like price-to-earnings ratios or, in real estate, cap rates, they aren't fixed. They're actually highly volatile, mostly because they reflect perceived risk in the market at any given time.
Yeah, think about the stock market back in the late 1960s and 1970s. We had massive inflation, geopolitical uncertainty, and it produced terrible stock market returns for over a decade. Why? Largely because price-to-earnings multiples collapsed. Investors demanded a much lower price for the same dollar of corporate earnings because the perceived risk of owning stocks felt so incredibly high. But paradoxically, that very adjustment, that drop in valuation multiples driven by fear, is precisely what created the incredibly attractive, cheap price levels that set the stage for the huge bull market that began in the early 1980s. The opportunity was born out of the pessimism.
Which means the best opportunity isn't always where the current consensus says it is. It's often where perceived risk is highest, assuming the underlying fundamentals are sound. And if shifts in perceived risk are what truly define market lows and market highs, well, that gives us our final question for you, the listener, to ponder.
Right. We've spent a lot of time discussing how decades of exclusionary zoning, policy-driven housing scarcity, and this ongoing urban inversion trend are creating persistent, even deepening rent burdens and affordability crises in cities all across the U.S. Now, if the logical result of this macro dynamic is heightened perceived risk and instability, especially for lower income housing segments, which might lead investors to demand a higher cap rate, a lower price for those assets, where are the hidden opportunities being created right now by those investors who can correctly assess the long-term structural need for more housing supply, especially affordable supply, and are willing to engage with that perceived risk? The real opportunity is often found hiding within the historical forces and present challenges that most others either fear or simply fail to understand. Where is that happening today?